Hello, everyone. Today on the final bar, I'm joined by Alessio Rutigliano. He's coming to us from London. He's a cryptocurrency expert, also works with Wyckoff Analytics. Our friend Roman Bogomazov highly recommends Alessio and his work. I'm excited to get his take on the cryptocurrency environment, which tends to magnify the movements that we're seeing in stocks, which overall showing quite a bit of distribution today. You're seeing the S&P down 2%, mid caps and small caps as well. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market dynamics using charts, focusing on the messages of price, trend, momentum, sentiment, breadth, all the information that we can use to understand the market dynamics and truly the mental state or the psychology of the market participants. We've talked about the distributive pattern that we've been looking at in stocks for quite a while. We've been talking about some of the distribution days that we've seen recently. And for months, we've been talking about the breadth deterioration, all right, how the market has been pushing higher, but breadth and sentiment measures have been rolling over. So days like today, while sudden and severe and certainly causing a lot of charts that have been looking very, very good for quite some time, starting to look a little not so good in the short term, especially. Two things to keep in mind. Number one, let's separate the short term movements from the long term. Focus on the long term trends, particularly the message of relative strength, which can be so helpful in this sort of environment when you see some dislocation. And also remembering that that it's all about the relationship between price and breadth and sentiment and how they relate. If nothing else, focus on price. Focus on what the markets are telling you. Make sure that you have risk levels laid out well in advance of a day like today. But we'll make sure we review as many as we can today. We have great guests on the show. I'm excited to talk with Alessio here in a few moments. Coming up later this week on Wednesday, the 29th, we have Dana Lyons from the Lions Share Report and Jay Lyons Fund Management. On Thursday, the 30th, one of my early mentors in the industry, Jeff Weiss, technical analyst at Clearview Trading Advisors in New York. Then the week after, on October 5th, we have Craig Johnson, technical analyst at Piper Sandler in Minneapolis. Also, just a few hours ago, we just finished recording our latest episode of The Pitch. We had a ton of fun with Joe Rabel, John Kosar, and Tom Boley. I moderated that discussion. We had a lot of fun, and it was particularly interesting recording that during a day when the market was down so much. I would encourage you to watch that. It'll actually air a little later tonight, 5 p.m. Eastern on Stock Charts TV. We'll show that also on demand. If you go to stockchartstv.com or our YouTube channel, you'll be able to watch that on demand as well. But certainly check that out. It was a lot of fun. We're going to continue on with today's market recap. We're going to start with a poll. We asked you recently, what time frame do you use most often for charts? And gave you four options: intraday charts, daily charts, weekly charts, and monthly charts. A vast majority, 72% of you, said daily charts were the time frame you use most often. And we are kindred spirits because in the course of doing this show, we look at a lot of 2-year daily charts. That's sort of my standard go-to look for a stock, is to start with the 2-year daily chart. And I often, in the course of my work, will look at longer term 5 to 7 year weekly charts and shorter term charts, 6-month charts, even hourly charts, depending on how volatile the instrument and how short term the movements that we're seeing and what you're trying to make sense of. But it's interesting. I think the real goal of that question is not to illustrate that there is a right answer, right? There is a good starting point for you in your process. So the way you should answer that question should be first another question, which is, what is my time frame? What's your investment horizon? That should dictate how you answer that question. I would also remind you that regardless of what time frame you operate on, make sure you use multiple time frames. My guest Joe Rabel on the pitch earlier today was talking about using multiple time frames, looking at a monthly, weekly, daily, and hourly time frame for every stock he looks at. And as close as you can get to that, the better you're going to understand the relationship, the interplay of those different time frames. So we encourage you to check that out. And thanks for answering our poll question. So the S&P carnage is a way I might describe this. Certainly distribution, devastation, however you want to describe it. It's only down 2%. But after a set of months and years where we've seen a lot of accumulation days, a day like this certainly feels severe and sudden, and certainly one of the deeper pullbacks we've had through the course of 2021. Let's look at how things played out. The S&P closed just above 4350, bounced up a little bit in the afternoon, but came right back down and settled in toward the lows of the day. So full on distribution mode for the S&P, down over 2%. Mid caps and small caps, by the way, down a little bit less than that. And I think that small cap outperformance, mid cap outperformance is certainly a theme to be watching. We are very used to the mega caps, the large caps leading the way higher. Days like this, when the market comes off, small caps are outperforming. It might be worth a look at some of those areas that you've been ignoring because they've been underperforming for so long. And I think with good reason. But now you're actually seeing them start to outperform in a down tape. The Nasdaq, by the way, accelerating, really leading the way down with the NASDAQ 100 down almost 3%. And the VIX has spiked back above 20 to get up to just below 23. Interest rates continue to go onward and ever upward. We have the 10-year yield settling in around 153, although the dollar sign TNX touched 156 earlier today. So we are getting back into the range that we were in earlier this year, sort of first quarter into the second quarter when we got up to 160, 170. So I think topped out around 175 on the 10-year. We're sort of getting back into that range with the movement that we've seen so far this week, and higher rates certainly lining up with stocks going down. The dollar index increasing. We're actually seeing the UUP get above 25, which it has not spent a lot of time above, and a stronger dollar is certainly an emerging theme to pay attention to. Commodities, a lot of red on the charts here, even though energy was the one of the 11 S&P sectors that actually finished the day strong today. Finished not strong, but not as weak as the others, I guess, up 0.3%, while everything else was in the red. But commodities as a whole going lower, gold and silver as well. So this is not a day where people flooded to the safe haven of gold. I don't think that's necessarily playing out as you might expect if that's what you're looking for. Cryptocurrencies certainly continuing to push their way lower. We've talked about Bitcoin and the range that it had been in between sort of 42 to 44,000, and where that's been a level of support and resistance. We're actually breaking below that level going into today. Ether as well, going down almost 2%. Again, my guest today, Alessio Rutigliano, very excited to hear his take on how to look at some of those popular coins and what may be ahead. Looking at a chart of the S&P 500 here. So we've talked a lot about the trend in the market. I actually added the 20-day moving average because, again, on the pitch earlier today, Tom Bowley actually mentioned the 20-day and how we've bounced. We've been testing the 20-day from below. So I threw it on here as we were recording just to kind of track that going forward. What we've talked about on this show is just this general trend, right? The overall trajectory of the market. We talked about 4 items to be looking for, and this is as the market's making new highs. Number one, do we fail to make a new high, right? The market has consistently made new all-time highs. At some point, the S&P has to attempt to make new all-time highs and fail. We've arguably seen that today. I think you might have formed the right shoulder of this distributive head and shoulders like pattern that we've seen emerge. But so far, it appears that we've attempted to make a new high, but instead of pushing up through 45.50, which is what has happened in these previous pullbacks, we've actually attempted to go up and it failed here. And so the question is, number two, do we make a new swing low? Now, we undercut the August low. That happened about a week and a half ago. And now we're right back at that low. We're right at the same level, the closing low that we've seen for the last 2 months. My question through the remainder of this week, do we continue to push down, break this neckline, and follow through to the downside? I've heard some people, and I think it's fair enough, see, looking for a break below 4,300, which would undercut the intraday or intra-week low from last week. And I think that's fair as well. So we're sort of right at that range where if you're bullish, you'd certainly want to see some support, want to see some rallying back to the upside. But overall, I think we're very close to signaling so much further distribution. The third and fourth things, by the way, number one, let's see, lower high, lower low, breaking the 50-day moving average, which I think we have completely now done given today's drop. We sort of broke the 50-day, we tested it from below, and now rotating back to the downside. So I think that's a check in the minus column, and then the RSI remaining below 60, which sort of indicates a rotation from a bullish phase in momentum to more of a bearish phase in momentum. I think that's where we're at right now. I think that's what we're overall starting to see as this market rotates a little bit lower. Now, the question is always what does that mean, right? Is this a short-term pullback within the context of the longer-term trends? And what's interesting is as we're seeing the S&P start to break down through support, the NASDAQ 100 is even a clearer head and shoulders top, by the way, breaking the neckline today and closing below it. What does that mean relative to the long-term trend? You're seeing at the same time things like energy that's actually rotating to the upside. You're actually seeing this sector testing resistance while the market is rolling over. You're seeing the relative strength actually rotate higher. So while you're seeing technology rolling over, you're seeing some of the cyclical sectors, and particularly things like energy, starting to break out to the upside. And the question I think I would be trying to answer is, where is the relative strength? There have been times in this market history where it feels like everything's going up, but certain things are outperforming and certain things are underperforming. On the other side, during times when the market sort of gets disrupted and you get a disruption in the market, certain things really start to work. And I would argue the relative strength line can be a really good way to identify where, what pockets of the market are people hiding in? Where are they actually seeing opportunities? And I think looking at charts like the XLE, is it able to power through to the upside? If you get pullbacks, are they putting in higher lows, which the XLE is doing while other sectors are starting to struggle? Could indicate a bit of a rotation into further strength going to year end. We need to take a quick commercial break. We'll be back with my guest, Alessio Rutigliano. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the market environment using charts. As I've reminded you many times on the show, if you know nothing else about a market, a ticker, a stock, an ETF, start with the chart. That will tell you, I would argue, most of what you need to know about the dynamics of that particular security sector, ETF, whatever you're looking at. All the other stuff can help you understand the mechanics of it a little bit more, but start with the chart. Couple quick comments before we get to today's guest, Alessio Rutigliano. First off, we love to hear questions from you, particularly questions that are coming up as you are analyzing your own charts. As you're using stock charts, trying to use technical analysis, trying to place stops and take profits, let us help you along this way. Go to email us your questions, by the way. The Final Bar at StockCharts.com is the best way to get a hold of us. We're on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We would love to get your questions. Hope to answer one of yours in our next mailbag segment on Friday's show. Also, as a reminder, go to StockChartsTV.com. You can use your email address, set up a free account, start watching all of our great content immediately from our website. Also from your mobile devices, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Alessio Rutigliano. Alessio is a cryptocurrency strategist at Wyckoff Analytics. Many of you know Roman Bogomazov does a great job sharing content on Stock Charts TV. Also, Bruce Frazier does a great job championing the Wyckoff method. And Alessio, it is great to have you join us today. Help us understand the cryptocurrency markets. Welcome to the show.
Hi, David. I'm very glad to be here today. So you know that crypto assets is great proxy for the speculative sentiment of the market, and historically, this asset class tend to outperform when all the U.S. stock market indexes are well positioned in the context of a well-defined uptrend. Right now, the stock market is still in the risk-off environment, so we have to be very cautious. And we see that many major cryptocurrencies actually want to retest the July support. So I think this is a good spot to study the market, to stock this uptrend, and study it from a very objective point of view. Because in the next weeks or months, we could actually have a very nice buying opportunity for cryptocurrencies. So we have to be very, very opportunistic.
Very, very good. Your first chart that you're bringing us has Bitcoin at the top and some crypto indexes at the bottom. Can you talk us through this chart?
Yes, of course. So we see in this chart Bitcoin, the US Growth Index, which tracks many emerging crypto companies, and the Asian Index, which has been deeply affected by the China crackdown on cryptos, and last but not least, the Mid Cap Index, which have performed quite well in the last year. So what do we see here? At point one, a strong momentum of the move of the COVID low at point one. After that, Bitcoin enters a 5 months consolidation. At point two, we see that other crypto assets are leading the market toward higher prices, while a long consolidation takes place on Bitcoin. So, and I think it's quite interesting to see that at point two, the Asian crypto index is leading the market toward new highs. And what happens next at point three? Actually, the selling pressure for the Nasdaq index is creating an interesting reaccumulation structure of the Asian crypto index and the US crypto growth index, while Bitcoin is a good beneficiary from the weakness of the dollar. So I think this is a great chart because we are monitoring several sectors in this very interesting asset class. What happens next at point four? So we see that the Asian crypto index is outperforming, beautiful rally, but at point five, this is a lower high is a great sign warning us that China is very serious about the crackdown on cryptocurrency. So we see that this is the phenomenon that is dragging down the whole market, and we are in this meaningful correction at point six. But this is a great opportunity for the whole market, especially the US companies, to outperform. And in fact, we see this blue zone area in the US growth index, which is a great reaccumulation structure. And this is a massive causality. And we have to keep in mind that we are on a logarithmic scale here. So these are big moves. So this reaccumulation creates a bigger uptrend, an uptrend which is not reflected yet in the structure of Bitcoin and the large cap index for the crypto market. So I think this is the time where we have to be very cautious because both Bitcoin, Ethereum, and large caps are still in a great reaccumulation structure. So we can potentially revisit the support, especially if the whole market want to continue in this correction. But the outperformance of the US crypto growth index, I think, is a great sign, which is warning us that cryptos could be actually a great sector for the future in US stock market and US equity market in general. So
This is such a great chart, Alessio, and I love how you're relating the sort of U.S. crypto exposure potentially with the Asian markets and looking at that divergence that we've seen here recently. We only have about a minute left, but I did want to get to your second chart of Ether. I've been a lot of discussion about Ethereum because at times Ether's actually done a little better than Bitcoin at different periods. Talk us through this one briefly. What are you seeing here?
well, Ethereum is today the backbone of blockchain infrastructure. So here you see two charts, the vertical charts and the point of figure analysis. So after the local distribution in May, we saw a lot of demand coming off the bottom in this value zone around $2,000, classic accumulation structure, selling climax, automatic rally, spring and a test, and now we're consolidating at the top of the structure. So I don't like, honestly, the high volatility that we're seeing off the top, which is really a good sign for speculative asset like crypto. But the failure on the resistance could actually lead us toward the support of this multi-year accumulation structure because we have to keep in mind that we have higher targets for Ethereum, and this accumulation is just a part of a much significant uptrend. So I think that the we can actually retest the support of this structure, and that could be a great opportunity for opportunistic traders.
Alessio, this is a lot of fun. I really appreciate you coming on the show, sharing some thoughts with us on cryptocurrencies. Piacere. It's great to meet you, and it's great to have you on the show. I'd love to have you back again sometime soon. But until then, stay safe and be well.
Thanks for having me, David.
That's Alessio Rutigliano. Alessio is the cryptocurrency strategist with Wyckoff Analytics. Did a great job. That first chart actually showing Bitcoin along with the U.S. and Asia crypto index. It was actually very very interesting. I love looking at cryptocurrencies over time. It's so easy to get caught up in the short term movements on a lot of things, but especially cryptocurrencies because they're so volatile. But what I love about the Wyckoff method, and I think what Alessio did a great job of describing, is just the structure. It gives a structure to a market that can feel unstructured and uncertain. It was a great history lesson the last couple of years on Bitcoin and Ethereum. Great guidance as well. Let's continue on with our next segment, the final bar mailbag. As I mentioned, we're here for you At all times for your questions, our email is thefinalbar@stockcharts.com. Keep your questions coming. They've been very, very thoughtful, and we appreciate, especially when you include charts with questions. Helps us understand what you're referring to. Let's get to the first question. Thanks to Grayson Rose for his episode on parabolic SAR for stops. How would you combine this with other indicators? And you were referring in your question, you had a link to one of Grayson Rose's show. He does a great job hosting Stock Charts in Focus, which airs records it every Friday, and it's featured in our Chart Watchers newsletter every Saturday morning. Grayson has done a fantastic job. In earlier this year, he launched that show and has done a great job sort of explaining a lot of the methodology of how to use the Stock Charts platform successfully. He was talking about some different stop ideas, and in particular, he was talking about the SAR system, the parabolic SAR system. This is actually an indicator created by Wells Wilder. He's the one that created RSI, DMI, the ADX line, a number of things. He created a lot of technical indicators in the 1970s, many of which we use and think of as they're included in most charting platforms and are sort of commonly used techniques. But he really, for lack of a better term, charted new ground by coming up with some of these indicators. The parabolic SAR system is a great way to use a trailing stop. And Eli Lilly is an example I brought up here. When a market starts to go vertical and continues to go up, what's great about something like this and some of the other trailing systems you can use is that it's dynamic. So it follows the price. The more aggressive the price movement goes up, the way it's calculated, it actually increases. You can see when it's more sideways, you can see the trailing stop is sort of going up a little bit, but then when it really accelerates, you can see that the stops accelerate as well. When it breaks that SAR and hits it, SAR actually stands for stop and reverse. So it's stop your long position, reverse to a short position, and write it down. That's sort of the general methodology. So your question was, how do you combine it with other indicators? And I think that's a great point. With anything like parabolic systems or ADX or moving averages, it's hard to use them in a vacuum. And if you see, we rarely just talk about one indicator and that's it. It's sort of a mosaic, right? It's a checklist of what are all the indicators telling you. But at times when the market really accelerates, something that's just a pure stop can be really helpful just to make sure that you lock in gains. And I think that's where the SAR system can come in pretty well. I actually combine this with RSI because I found a lot of times, particularly at turning points, you'll find that something like RSI, I think it was more of a leading indicator, whereas the parabolic systems are more of a lagging indicator. That's going to tell you when the trend has reversed. Something like RSI tells you a warning sign when the market may be overheated, a divergence when the price goes higher and the RSI slopes downwards. Those are warning signs that the conditions may be turning. Then when the SAR, when the parabolic studies is triggered, when it actually breaks the SAR level and it pops up and signals the other side of it, that's where it kind of combines it. So you have the leading indicator indicating that the market's overextended with the lagging indicator of a trailing stop. So I would think of it as something like that. What I don't think you need too much of are other things sort of lined up with the price, because I think with the parabolic system you have it pretty well covered. I would look at something like a momentum indicator that might be a good complement to that. Next question. One of the problems I'm having with technical analysis is learning how long it takes a move to play out. Any suggestions on the time frame for signals? That's a tough question to answer directly, only because the short answer is it depends, right? It depends to a great degree on what type of chart you're looking at. The average chart that I look at is a 2-year daily chart. I tend to look at a lot of some shorter term charts, also longer term charts, looking at weekly charts when I'm really trying to understand a stock or an ETF and look at the longer term trajectory. But at the end of the day, the chart you should be using should be dictated by the time frame that you're on. So if you're trying to understand the next couple minutes, you better be looking at a 1 minute, 5 minute chart sort of thing, telling you about the short-term dynamics on the stock. If you're trying to understand, in my opinion, cryptocurrencies and what might be coming over the next couple days to couple weeks, I'd be looking at an hourly chart of something like Bitcoin or Ether, because I think that captures the short-term trajectory of a very volatile instrument. If you're a long-term investor looking a couple months, couple years down the road, then you better be looking at weekly and monthly charts, because that's the time frame that's going to help you understand that. So the signals that come out on those charts are less about the indicators, I would argue, more about the time frame of the chart that you're looking at. The general, and this is a huge generalization, whatever outlook, if you're looking out a couple months, I would generally look for like 6 to 7 times that history going back in the past. So if you're looking a couple months out, which I'm usually looking a month or two out, that would mean you take that, you multiply it by, you look like 6 or 7 times that back. That's like a year and a half, 2 years. And that's kind of why I look at a 2-year time frame on average. I would think about that. And again, at the end of the day, it's whatever chart, time frame, and indicators are going to help you get a read on the time frame you're trying to capture. And that's the first question I would answer. Probably the last question. Do you look at anything lower than the daily time frame? If so, do you turn the extended hours view on? Is there a benefit in your mind? Would you suggest it for short-term swing trades? So we don't look at a lot of intraday trading on the show, only because with the limited time and with the time frame that most people are looking at. You saw from the survey earlier today, most of the people watching our show and watching Stock Charts TV are a little longer term. They're looking at daily, weekly charts on average more than anything else. Having said that, we have plenty of tools, particularly our new ACP platform, to help you understand the short-term dynamics even better. You were actually asking about the extended hours, and below the chart, you have a little button to put on extended hours. And your question is, should I be looking at it? If I'm looking short-term and I'm trying to understand the short-term dynamics, intraday movements of a stock, I would absolutely be looking at the extended hours, because what that does is it captures data, right? It shows you where trades are actually happening. You can see based on the spottiness, and depending on what stock you bring up, it's obviously going to be a little more or less liquid. But those after-hour sessions, after the close, before the open, can be a lot. There's a lot less volume there. It's a different group of participants. There aren't a lot of institutional players that are making a lot of movements pre or post market. It's a different sort of a community of trading that's happening. However, if you want to understand the dynamics, particularly around earnings, I would absolutely say it's helpful. When you see things happening, news flow that could impact the stock during the trading day. So something like earnings, big news that happens after hours, not just on that company, but macro news that's going to impact the movement of stocks. It could be a great way to get a read on some of the intraday behavior. In my experience, when I've used technical indicators, things like RSI and others, I tend to not include those the pre and post market, only because they're less liquid. And I think technical indicators are only as good as the data that comprises them. So if you're including some periods with a little less, transparent data, a little less volume than the main part of the day, you may be getting some weird signals on some technical indicators. So that's generally how I would think of it. I would tend to use it the pre and post market for indicative signals, particularly around news flow. If I'm running technical indicators, I would tend to avoid using the extended hours on your charts. Great questions, and guys, thanks so much for sending those to us. Keep them coming. The final bar at stockcharts.com is our email. We need to wrap today's show though and go to the 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is the NDX. I mentioned earlier we were recording the pitch, and if you missed it, go to stockcharts.com/the pitch. We're running it live at 5 p.m. on the channel here, but you can see it on demand there. One of the things we were talking about as we were doing the technology checks earlier was the head and shoulders pattern. You see it on the S&P, but the neckline is actually sloping downwards. On the NASDAQ 100, the neckline is actually super straightforward. And today, you've arguably broken that neckline, a high surrounded by 2 lower highs. We've broken the neckline. That measures down at least to the 200-day moving average, which would put the NASDAQ 100 below 14K. Chart number 2 is the bullish percent index, not on the S&P 500, but on the energy sector in particular. I have a chart list that actually looks at the bullish percent readings on each of the 11 S&P sectors. This literally basically takes the point and figure charts of all of the energy stocks in the S&P. What percent of them are in a buy signal on their point and figure charts versus a sell signal? You can see as of today, it's over 90% of the energy sector. Again, the stocks in the S&P in the energy sector are in a buy signal. It's one of the highest readings you've had, but look at how that's rotated higher from low teens percent about a month ago to up over 90%. This mirrors very well the relative strength of energy rotating higher. So I'm very keen on sectors that do well when the rest of the market is not doing well, and the increasing or improving breadth in energy is something maybe not to ignore. Finally, I had to ask my panelists earlier today which of the FANG stocks that they would be looking at. None of them picked any of the FANMAG stocks, as I would call it, or FANG stocks, as one of their 5 stocks for their pitch. But one of them identified Netflix as sort of the best of the worst. All 6 of those stocks, the FANMAG names, have rotated lower today. Netflix was actually the best performer out of that group of 6 stocks. And overall, if you look at the weekly chart, look at the multi-year daily chart, you can see it's certainly been in a basing pattern. Most recently has broken to the upside. Very interested to see if that trend continues. Folks, that is our show for today. Thank you so much for joining us every weekday after the close. Special thank you to Alessio Rutigliano. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, Hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.